Welcome to the Money Insights Podcast, where high-income earners come to learn wealth-building strategies that will take them from high income to high net worth. With your hosts, financial and wealth-building experts, Christian Allen and Rod Zabriskie.
Welcome into the Money Insights Podcast. We talk all things money and business. Hey, everybody. My name's Christian Allen. I'm with my co-host, Rod the Pod Zabriskie. Rod, what's up, man?
Hey, I'm doing great. How are you?
I'm well, thank you.
Good.
The snow stopped just this morning. It was snowing earlier this morning, but it stopped
Yeah,
as of right
for a
now.
minute.
And hey, guess what? I'm going to Disneyland this week.
Yeah, no snow there.
No snow there. It's supposed to be like 65 to 70-ish degrees. Like,
That sounds
it's
amazing.
not, it just is, for me, that's perfect. I like it a little bit cooler, but
Yeah.
sunny. Anyway, my kids are huge Disney fans.
Yeah.
So we are going to go rock out at Disney World Disneyland. We're going to Disneyland this time. And anyway, I'm super excited about it.
That sounds amazing. Well, 65, 70 sounds much better than 35 to 40. So,
Yes. Or just a couple days ago, it was like 20.
yeah.
Hey, Rod, have you ever heard of Disney bounding?
Only from talking to Heather.
Oh, okay. You had a conversation on this, so I won't get into it. This was a new thing for me, but I just thought it was interesting. So my kids, like I said, they're super into Disney everything, and
Mhm.
they're theatrical kids, right? So they
Yeah.
like to get into the theater stuff.
Yeah.
Anyway, they like this Disney bounding thing is basically where you dress up in the colors or kind of like in like the mantra, overall style of a Disney
Yeah.
character. And the reason you do that is because if you're 13 or older, you can't. Disney says no more dress up.
No actual
You
costume.
can't dress up in costumes like characters and stuff. So anyway, but what you can do is kind of create the essence of that. So
Mhm.
I have got a Donald Duck outfit that I'm rocking. Heather got me a blue beret to go with
Nice.
it.
I love it.
I'm pretty excited about that. And then just a classic like black and red Mickey. I got red shorts, black shirt, Mickey ears. I'm ready to rock and roll. So
That sounds amazing. I can't wait to see the
anyway,
pictures.
yeah. I'll make sure I try to not send them to anybody. But
Okay.
okay. I doubt, Rod, that people are tuning in to hear about my Disney adventures. So let's get into the topic, should we?
Let's do it.
Actually, hold up. We can't get to the topic yet. We got to announce the virtual summit.
Okay, yeah.
The virtual summit happening on May 4th. Tickets are on sale right now. Go get them. We've got an awesome speaker lineup that we're super excited about.
Yeah.
We've talked about it. We have Sharon Lecter, Tom Wheelwright, Adam Carroll, Buck Joffrey, Chris Larson, Rod Zabriskie,
Christian Allen.
and Christian Allen. Okay.
Yes.
Okay. Well, we're excited about it. So it's a one-day only thing. Now, just to clarify for everybody, if you're wondering about purchasing tickets and you can't make that specific day, we are going to do the recorded version. So if you can't make it, you can still buy a ticket and we will get you the recorded version of all of the talks. So you don't have to worry about that.
Yep.
Okay, Rod, on to our topic for today. So our topic for today is one that we run into quite frequently,
Mhm.
right? And we gave an example of this, but I think overall, this concept is really important as it relates to wealth building and investing. So
Yeah.
the question or the topic is price or cost versus value. And this is like an ongoing raging debate. I say that like most people agree that like value is more important, and yet how often do people get stumped on a price not understanding the value, or vice versa?
It happens all the
right?
time. Absolutely.
Happens all the time.
Yep.
Okay, one of Warren Buffett's favorite quotes, Rod, is he says price. I was going to say he says. He's actually quoting his mentor Benjamin Graham. I want to give credit where credit's due, but Benjamin Graham via Warren Buffett's favorite quote is price is what you pay, value is what you get.
Yeah.
Okay, that's interesting, right? There is a difference between what we pay oftentimes, and not always, but there is usually a difference between what we pay for something and like the true value that we get out of it.
Absolutely. And when you're at that moment making the decision, there may be some perceived value that you are thinking you're going to get that's not there. Sometimes we do that to ourselves. Sometimes it's sold to us in that way. They create
Yep.
that perception on purpose. But yeah, absolutely. And this is one of those things that you have been very consistent with from the day I met you, and probably long before, in not just life in general, but what we do, like the way that we approach our business.
Yeah.
That we have to create that value for people, because if they're going to want to work with us, if they're going to want, like, if it's going to become a topic of conversation for them, and they'll speak about it with pride to the people they care about that are, asking what the kind of things they have going on, it's because we created that value. We provided that value for them. And if we don't do that, then no manner of price, so to speak, for someone else, or perceived price, would cause them to recommend people to us if we're not providing the value.
Yeah, I think any business, like at the core of any business, is the value that they provide, right?
Yep.
That's
Yep.
how you get a good business that has an opportunity to grow and provide value to a lot of people. Okay, Rod, when I create these outlines, a lot of times what I'll do is, once we come up with the topic,
Mhm.
I'll do a bunch of reading, and I'll read various articles, and usually kind of bring things together to come up with like our line of thinking, our philosophy around something.
Yeah.
But I always want to give credit where credit's due. And so I'm using some material from Phil Towns. I think it's Phil Towns. I'll double check on that. And he wrote an article that was in the Wall Street Journal that was basically on something. It wasn't exactly the same, but a very similar topic.
Mhm.
And so I used some of the information from his to create our outline, mixed with a bunch of things from other people. But one of the things that in that article that stood out to me is this concept that he says cost or price is arbitrary and value is fundamental. Okay, so let's talk about some examples. Well, actually, before I go to that, Rod, when you hear that, what does that mean to you? What do you think of when I say price is arbitrary, value is fundamental?
Yeah, this is an interesting thing, because right now, think about real estate, the price attached to real estate these days. And I mean, one like extreme is always, and one of the reasons that this is a big topic right now is that our daughter Julianne and her husband Curtis, they just graduated. He just finished graduating. He got his master's. They're ready to buy their first house.
Yeah,
Okay. And
exciting
some might
times.
say, "Wow, this is not
They're
the
like,
time
the
to be
price.
buying."
Yeah, okay, I can relate to that, by the way. I bought my first house in 2007,
Yeah.
and the attitude then was, you just got to get in before it keeps going up, right?
Mm-hmm.
That was the advice I was getting from people. That was brutal. Anyway, sorry, I didn't mean to,
Yeah,
to
and
take your line.
we're in the Utah market. Prices accelerated like crazy over the last 3 or
Yep.
4 years. They've slowed down. They've even come down a little bit. But now interest rates, and I think there's a relationship there, right? Higher interest rates means costs can't keep going higher. But then it's funny because you take it back 2 generations. So I was having a conversation with my wife Jody, and she was talking about how, like, it was always hilarious to her when her mom would talk about the first house they bought, and they bought it for like
It's like
$10,000.
Right.
Yeah.
I know.
Yeah.
It's crazy. It's crazy to think about.
Yeah. And then the first house we bought was like 150,000.
And
right?
now that's crazy to think about.
Yeah. And now this home that they're looking at, they put an offer on for, I don't know exactly what they offered, but basically 300, probably 330, something like that.
Mhm.
And it is like, it's really hard to look at that and say, man, that is worth $300,000. But again, we have this tainted view of prices right now because of our own experience and hearing our parents' experience. And then now, here's our kids going out and buying a house, and it's just really hard to imagine the prices they're paying now for what they're getting.
So the question is, well, we're going to get into the investor part of this because I think that's critical. But think about the idea of value investing in general, right?
Yeah. Mm-hmm.
It's an interesting concept. You're basically you're basically determining that you believe something is of lesser value over the long term, and that there's outside non-fundamental things that are, driving price. So,
right.
or driving the price up. And that's kind of what people do in the real estate world, right?
Mhm.
Good investors often are doing a similar type of thing that the value investors are doing in the stocks world.
Yeah. And I think that goes back to what you were saying. Cost/price is arbitrary. That's like ringing true right now as it relates to this whole thing with this real estate situation that I'm specifically mentioning, but even in general, because like you say,
Yeah.
we talk to a lot of people on a regular basis who feel like opportunities are coming. I'm hanging on to my cash because I want to be ready when they come.
Yeah.
Basically what you said, this
Yeah.
idea
For
of
sure.
value coming, and there'll be people in a pickle who have to sell at a discount, etc. And so they're biding their time until that comes.
Hoping to get that. Okay,
Mhm.
so let's go through some examples of, and we could come up with several of these, but I thought it would be fun to talk through a couple of them.
Yep.
Okay, so the example that they gave in the article is what I want to start with, just because it's easy to distinguish, it's clear and concise. So the example they said is someone selling a gold bar. Okay, we'll think like a gold bar for,
Mhm.
I don't know how big it is, but any gold bar for $5, only $5. It's a really simple, like a simple example, but what they're saying is while the price of that gold bar is $5 and that person priced it there for whatever reasons they
Mhm.
felt were necessary or reasonable, right?
Yeah.
However, anybody, like we all kind of just know that the value of a gold bar, even if it was a small gold bar, is significantly more than $5, right?
Absolutely.
Okay, that's kind of our first example. Now we're going to get into more like practical examples that we might run into. This is one that I thought of because I feel like I've run into this before. Okay,
Yeah.
so my kids have all had like a favorite item. They liked their blankets when they were super little, right?
Mhm.
And that blanket was probably like $8 to pay if you were going to go buy it at the store or something. Maybe not, because somebody knitted it. Cannon's blankets that he loved were knitted, so maybe it was like
Okay.
15 or $20, but not very much, right?
Yeah.
But can I just tell you, when he didn't have that, like if he lost that blanket when he was little, or like he needed it to sleep, whatever, can I just
Mhm.
tell you, I would have paid significantly more for that blanket.
Yeah.
It was worth like, there's been times where that stupid blanket's probably worth like thousands of dollars to me. I'd be like,
Yeah.
if it's gonna do this, then I'm willing to pay it, right?
Yeah.
Okay, that's obviously another extreme example, but it's kind of another example. The value, while the price tag was really low, the
Mhm.
value to me, the value to my kid is so much greater than the actual price tag. So in that
Yeah.
situation, I'm probably not worried as much about price, because I'm going to get something out of it that the price really, doesn't give me. Okay.
Right.
So now, Rod, I want you to get into this example, because we deal with it. We talk about it and deal with it basically every day, right?
Mhm.
You probably multiple times a day. Okay. So talk about how this comes up in our daily world, specifically around life insurance strategies.
Yeah. Okay. So probably the one that comes to mind first is the investment optimizer. And especially because even in our own material, we put it out there and say, hey, if you're building up your opportunity fund inside of a savings account, it comes at a quote unquote cost, right? Because you have opportunity cost and or just inflation, all that kind of stuff, eroding the value of what's sitting there waiting for the next deal, right? Or instead, you can put it into these types of specially designed life insurance policies where you get the same safety and liquidity, but you can create a 5+% net return that's tax-free. And so the money is actually doing something for you between deals, and even during the deals, the kind of, creating value in multiple places at the same time, all these different things we talked about with investment optimizer, right? So we're selling value. We're saying, hey, this is what you get by participating in setting up this type of policy and using it with your investing. And yet it comes at a cost, right? In order to get there, you have to have the life insurance policy, which comes with a cost and that's a cost you don't get with the bank account, right?
Right.
Hopefully, right? The bank stays there and your money's there when you're ready for it, all that kind of stuff, right? So, so that's basically what we're proposing is we're saying, hey, there's there's more value. Like in that specific example, when we show the side by side, use the investment optimizer instead of using the bank account, and here's a person A, person B, doing this over time. At the end of 20 years, we show in that example that with those specific numbers, a difference of $2 million that the person who used the investment optimizer has, that the person who was just using their savings account doesn't have.
Yeah.
But they have to, anyone who then decides to participate in it has to believe in that value, pay that cost to get there. Because if you don't pay the cost, you can't get there.
Yeah.
Right.
And it's a really interesting, like this concept, the philosophy around cost. It always has been one of those things that's a little bit mind boggling to me, only because, well, I'll give you an example. Let's talk about hedge funds for a second, because
Yeah.
I just think this is a really clear, good example of how this works. So hedge funds are notorious for having a much higher cost to them, a much higher price to the investor.
Yeah.
And usually it's a cost of like 2% as an annual fee, and 20. This is just like your ho-hum average run of the mill hedge fund. There's hedge funds out there I've heard of that are doing 5 and 50. When I say that, I mean 5% on your underlying balance, on the underlying balance of the total account, and 50% of the total gains. Or 2 and 20 would be 2% and 20% of the gains.
Okay, wait. So just to clarify, if I have, again, it's a hedge fund, so it has to be a big number. Let's say it's $1 million in hedge fund. You're saying that I know I'm going to pay 20,000 because that's 2%.
Yep.
But then if they grow that $1 million and they turn it into $2 million, I'm also going to pay them $200,000 because that's 20% of what they were able to gain for me. Is that what you're saying?
Got it. You got it. Yep, exactly. Okay. So, and then what's typical, if you go to like a typical advisor who's just kind of helping you invest in the market, doing your kind of typical advisor things, asset allocation, rebalancing, those kinds of things, that is normally going to be around 1%, maybe 1.5%, right? Maybe. So that's again, specifically, that's the fee that's going to the advisors, the people managing. So when you think about that, and really, if you go to like a mutual fund, it's even going to be less than that, right? The mutual fund managers might get like 50 basis points or something like that, right? So my point here is just to say that typically it is much, much lower than that. So here's the question that you'd have to ask yourself: why in the world, Rod, would anybody pay 2 and 20 or crazy enough 5 and 50 for a hedge fund if they could get the same thing for well, guess what? They wouldn't.
They don't get the same thing.
They don't get the same thing. But so here's the question: why does somebody go and pay that?
Well, they would only pay it if they felt like that it was going to create a lot more value for them, right?
Right.
And it's the same $1 million, I could instead be paying 10 grand or 15 grand for the fees. It seems like a no-brainer, right?
Yeah.
However,
so what's happening then is that person believes that the value is coming from the ability to invest and create returns. Even like they believe it would be significantly above what you could get in those other places. Therefore, you're willing to pay that. And guess what? If that's the case, you're absolutely. Many hedge funds have proven to do exactly that. Well, one of the things that I've always thought was interesting there is, well, what people generally are known for investing in hedge funds. It's usually wealthy people, right? Wealthier people. The reason they do it is because they know that there's value there, right? They know that and oftentimes it's like selective, and you're like, I'm trying to think of an example here, but in many hedge funds, you might have to have a certain minimum. Like I had years ago, 20 years ago, my wife was a nanny for a family that had moved from Virginia and lives in Salt Lake. And he was a hedge fund manager, and their minimum per account was 5 million.
Okay.
So you had to bring 5 million. You went way low in terms of like where that needed to be. So yeah, his was like an energy fund, and they were, I think the minimum was 5 million. Anyway, my point is just to say that like wealthy people are able to get in and want to get in oftentimes because the quality or the value they're getting is so much greater than even the value that the people are getting who are paying much less. The price tag might be much higher, but the gains are also much higher. So when you think about that, like it is arbitrary. Price oftentimes is arbitrary because we don't know the value that we're going to get back out of it. In the life insurance example, I'm going to pay maybe, let's call it 1% over the life of the policy to get 5+% back. So that means like, have I really paid? Like I kind of have paid something, but I've still netted out more than I've netted out my 5+, even including the fees. So like, what's the true cost of that?
Yeah.
Right. It's an interesting conversation.
It really is.
Okay, I think I have one more example. Let me see. Yes, we do have one more example. Actually, Rod, you can bring this one up because we talk about this all the time too.
Mm-hmm. Yeah, so we wrote down the name Tom Wheelwright. This is a conversation that we have, but between you and me, but also with our clients all the time, because he's a really well-known accountant in our space, in our community. But if you want to have him do your taxes, you're going to pay a bunch for it. I don't know what that is. I'm not paying him, right? I'm not.
He's well known,
accountant.
But he's also well known for having a significant price tag, right? Yeah. Because, well, again, why does anybody go to Tom Wheelwright then?
The people that I know that are going to Tom Wheelwright are people who have millions a year of income and save hundreds of thousands, if not into the millions in taxes by working with Tom. So they pay him a lot. Again, I don't know exactly how much they're paying, but for what the value they're getting out of it, they may pay him 10% of the actual value that he brings, the actual savings of tax that they have. So
what's interesting though is they have to believe that by going to Tom with his additional level of expertise, that he's going to be able to save them more in tax than if they were to go and pay somebody much less.
Yep.
Like over the net on that, you're going to want it to come out on top.
Right.
But that's the interesting thing is lots of people are able to do that because there is a difference. Like someone like Tom obviously knows the difference between price and value. So he's like, I have no problem charging that because the value that I'm bringing is so much greater than the price tag. In fact, some people in that situation would think that they're a huge bargain. I think about like a surgeon, think about a really specialized surgeon. They might be getting paid $1 million a year, but that could be like an ounce of what they're actually worth if they're saving people's lives.
Right.
You know what I mean?
Yep.
So anyway, just a couple of examples of price for sale. Okay.
Can I bring one more up? Just as we've been talking, it just come to mind because I mentioned earlier that our daughter's buying this. They're buying this house, and the other day we were also talking about loans. So when you go and you evaluate loans, you have all the different factors that come into it. There's the actual interest rate, but then there's closing costs and other fees that come along with it. So you have to boil it down. And so we talked about this whole idea of the APR being the conglomerate of all of those things brought into a rate that you can use to compare.
Yeah.
And what was interesting is that she kind of talked me through the different places that she had talked to about potentially getting this loan. And she already knew she was not going to pay. She was going to pay a higher rate for the people that she was choosing to go with, but it's because they were clearly bringing more value. So in other words,
that's impressive.
When she looked at like the credit union where they have their accounts and talked to them about a loan, they got a rate, they got the information they needed, but they just didn't have the same experience with them as they did when they talked to the person they're going to go with. Because he came and he brought value. He said, okay, well, if you do this, this, and this, then you can either reduce the amount you have to put down or whatever, right? There were just several different points where he was clearly bringing value. And so she's making a conscious decision saying, hey, I'm willing to pay more of an interest rate because I feel like the value he's bringing back overcomes that. Like I'm going to pay less total dollars out of my pocket over time because of him bringing that value, even though the actual rate will be higher.
Okay, Rod, I have to just give you the question. How do you feel about that? I know that we're talking about price and value, but I'm just thinking about, I'm just like taking in the experience you just said. And I'm like, okay, so, but generally like a loan officer or something like that is someone you sit down with like for an hour once. Do you really want to pay a higher interest rate on a loan that's 30 years for a meeting where someone provided more value in 1 hour?
Yeah, no, then these are exactly the things that were going through my head as we're having this conversation. But where I ended up was because she was talking about, it was true value, right? It was like truly on the one hand, they were just saying, well, how much are you buying the house for? And here it is. And he was saying, well, here are different things you can do if you use conventional versus FHA versus, doing this or that to where it really looked like from what I could see that.
So maybe structurally from the loan and that kind of perspective, it still was creating more value than what they were getting. Okay. Yep. So it wasn't just like better service. It was actual value.
Yes. Yeah.
Okay.
Exactly.
Okay. Yep. I think I confused that in my head. That makes more sense.
Kind of like the Tom Wheelwright thing. If he can bring more ideas that bring more value, then you pay them more. So,
I don't have any problem if I think about, I paid a lot in tax last year, Rod, and I can just tell you that if someone came and said, hey, Christian, you pay me $100,000 and you'll pay like $300,000 less in tax, I'd be like, well, sign me up for that. Right?
Yep.
Unless, of course, I knew somebody that could do it for like $5,000. But the problem is that doesn't usually exist.
Right.
Value oftentimes does increase the cost of something. Okay. Yep. Rod, why do you think understanding the difference between price and value is important, specifically when it comes to investing in wealth building?
Wow. There are a lot of different directions I could go, but I think to sum it up, there are risks out there that we sometimes don't recognize. There are, I often say this, like the loudest voice would point you toward like everyone should always do this regardless of who you are and your situations and all this kind of stuff, right? Like throw a blanket over everyone and everyone should do the same thing. And I just don't think that's the case at all, because different people value different things. They may be looking for something different in their investments. So a person who takes kind of that Robert Kiyosaki philosophy of creating passive income compared to the person who says, no, I'm going to create this nest egg to take me to the promised land where I can be, independently wealthy. They're two very different approaches, and you'll bring different expectations or different measurement of value depending on your approach and what you're looking for. So that's why each individual investor has to look at it themselves. And we try to bring, like principles that can be useful in doing that. And I really feel like this is one of those where, regardless of who you are, what your investment philosophy is, what type of things you like to invest in, if you can boil it down to what are the things that you value, because that's what was the word you used before? That's fundamental. Value is fundamental. And then you do have to pay a cost for that. That's arbitrary, but it's arbitrary because you have to match those two together and get to a place where you feel like if you're paying higher costs, it's because it brings higher value. But if it's not going to bring the higher value, don't just pay the higher cost just because.
Yeah, right? Absolutely. 100%.
I don't value a Louis Vuitton anything, so I never buy anything like that. Whereas there are people out there who do, and they'll pay the higher because there's value that it brings to them, right? Hopefully.
Louis Vuitton. I love it. Good example, Rod. Good example.
Yeah, thanks.
I can attest that Rod doesn't get a lot of value from Louis Vuitton. Okay. Here's a couple of thoughts on this. First of all, finding the difference between price and value is probably, as a whole, the most effective overall investment strategy. Now, Warren Buffett says that finding the difference between price and value is the most effective investment strategy, and it makes sense, right? Going back to this idea of value investing, right? Obviously, if I can consistently buy things at a price that is lower than their value, that's like how we create investment returns, right? Now, some things just kind of, you might buy at the value and they just kind of go up over time, but obviously it's significantly more powerful if we can find things that are lower priced and higher value. Okay, Rod, I think all of the reasons that you suggested there are right on point. Can I just provide a couple of thoughts as it relates to this?
Yeah, let's do it.
Okay, so first off, our man Warren Buffett says that finding the difference between price and value is the most effective investment strategy. That makes sense. It makes sense because if we can consistently buy or take advantage of investment opportunities that are priced under their current value, then of course, over time, that's another thing I was going to mention. And I think that this was also from Warren Buffett, but it might have been from his mentor, Mr. Graham. But one of the things that they suggested is that basically over time, it always comes to its value. Over time, it always equals its value. It might be higher or lower in a given moment for a myriad of different reasons. It could be fear, could be greed, it could be emotion, like a million different things. It could be earnings, whatever, right? All of these things come into play. But the reality is over time, they eventually come together. Yeah. So if that's the case, and you can consistently buy things at a discount or under their value, then obviously as those things come together, you have an opportunity to sell them and create significant returns. Better than if you were to purchase them at the current value in hopes that they just go up from there. Does that make sense?
It makes a lot of sense. And I think that's like a trap that a lot of people get caught up in is they say, well, I want it to prove its value before I'm willing to buy it. Well, if it has already done that, it's already run up, you may, again, it's hard, it's a different in each case, but you may just be buying it at an overpriced spot because which happens all the time, right? You watch the trends and you say, okay, well, the worst thing to do is to say, look at the 52-week price. It's at its high point. Now it's time for me to buy.
Right.
Now, does that say that you never should do that? Well, of course not, because sometimes the value keeps going higher, right?
Yeah. Well, think
undervalued 52 weeks ago, and it's still going to keep driving that price higher. But
Brett, I think about almost previous to the last year, the last 10 years in the real estate space, and really the economy as a whole.
Yeah.
Like any philosophy that was wait and because things are high and it'll go lower ended up, being the wrong philosophy. I guess I say that, and perhaps if it's long-term enough, that still could end up coming to fruition, right?
Yeah.
But anyway, it's an interesting thought.
Going back to what you said about finding the difference between price and value, like you have to actually look at it to say, hey, all these people were successful in investing in this stock, therefore I should buy it now, is not the reason to buy the stock. You have to go and look at it and say, is there reason to think it's going to continue going higher? And if you truly believe that, then the price and the value, that difference between price and value is going to help you. But if not, if you're just buying because all these other people bought it, 2 years ago and it's done really well for them, therefore I should buy it now. Well, that's not going to be the right mindset to go into.
Okay. So Rod, when I think of this difference between price and value, the first stock that comes to mind is Tesla.
Okay.
Now, whether that's true or not, like whether the value is as high as the price on it, who knows, right? We'll see over time. But I just remember there was this, it was probably, I don't know, it was in the last year or two that it just like skyrocketed, right? Overnight. And like every day it just felt like it was going higher than the next. And really a lot of people, probably won big getting into that. I don't know where it's gone. I don't own Tesla personally. But that's just one that comes to mind as I think about, I remember thinking like that thing is incredibly high price. I can't imagine that it's really going to be worth that long term. Interesting. But again, that's what makes a good investor, or being able to guess that, or guess isn't the right word, adequately analyze the data and make good decisions consistently is what makes really good investors.
Yep.
Okay, Rod, I liked as we're talking about good investors, I liked this list that Phil Towns gave us. He basically gave us 4 M's that will help us become better investors and specifically help us find value in our investing. Okay, so here's what the 4 M's are. We'll just roll through them quickly. The first one is meaning. If it has meaning, you'll understand it better. be more likely to research it and be more passionate about investing in it. This is kind of obvious. I think we all intrinsically know that this is true, right?
Yep.
If there's things that we just care about, I think about, I'm going back to Warren Buffett. I think he said that he buys things that he's interested in. He buys things that he believes in, those kinds of things. The value isn't just like the moral, like a win from a morality standpoint, although that could be important to us too, but it could be the difference in doing it ends up being that we spend more time, energy, effort, get more out of it, and then ultimately make better decisions. So I really like this idea of providing meaning.
Yeah, I like it. Because that alone can make all the difference. Because like you said, if you choose something that you can't get behind, your energy, your life energy, you can't like devote it towards that, then you're just probably not going to be successful in it. So I think it makes a lot of sense.
Okay, Rod, the second one is moat. And I was like, okay, this one's interesting. Moat. Okay, Rod, talk a little bit about it. Cause I mean, I've basically spelled it out there, but you've got some good examples of what this is. So describe what that means, first of all, and then jump into an example that you've got.
Yeah. So on moat, you're just creating some separation between you and the competition. And that can take on a lot of different forms. The example you have here is like Coke's brand is their moat because no one else can be Coke. Like they can create what they feel like is a superior tasting or more healthy alternative to Coke, but they're not going to be Coke, right? It's just the brand creates that moat. The other things are like what you might call barriers to entry of things like intellectual property or like a proprietary process that a company has figured out, or in the case of a lot of our investors, a syndicator has figured out or whatever, right? Like you feel like, hey, this group has something going on that creates a barrier between them and the competition so that I can get more value out of them. And these are examples where you might choose to pay more or whatever, like you said, with the hedge fund or whatever, that you can see the difference between price and value and put your money on the horse, on the jockey that you feel like can take you to the promised land.
Okay, Rod, I've got a great example of this.
Okay.
You ready? Here's a company that's done all that. If you're thinking about moat, the first one that comes to mind is Blockbuster.
Oh, yeah.
Okay, Blockbuster is a perfect analogy for what not to do, right? Now, I just say that in the sense that when you're talking about moat, they had a lot of good things, right? They were a good, strong company for a long time. So I'm not trying to, throw them under the bus, but I am suggesting that they did not have the moat, right? They were missing something that delineated them significantly from other people. And because they didn't have that, and ended up being what basically shut them down over time when Redbox came about.
Yeah, Redbox and then Netflix, and it just like that.
Yep, it just and that's it. Redbox has almost like gone out of business because of Netflix, right? So it's just kind of next level. It's kind of interesting. Yeah. So I do think it's a good thought though. When you're looking for a great investment, this really rings true to me. Looking for investment opportunities that are doing something different. Oh, okay. So I'll give you an example. Now, I know that other people describe this a lot, but we work a lot with Western Wealth Capital, and their moat, I think, is their process, right? Mm-hmm. They feel really strongly that they're able to create value through a really well thought out, defined process that they're using. So that ends up being kind of what sets them apart and makes it difficult for other people, other syndicators to maybe perform as well. Okay. And like you said, other examples, intellectual property, that kind of thing. Okay, Rod, the third step is, and this is interesting because we talk about this from a principle standpoint all the time when we're talking about how to find a good syndicator. The third step is to look at the company's management, right? So if you're in a syndication situation, you're looking at the people who are running the things, the operators that are managing on a day-to-day and making investment decisions. You're looking at track records, because obviously a company that has strong management that's trustworthy and talented is going to give you a much better opportunity to create a higher return.
Absolutely. And the opposite is true as well. The correct property, the correct timing, everything else, but the wrong manager, and you're not going to get any success. It fails.
Yeah, well, and it could be devastating, right? If you get someone who just genuinely doesn't know what they're doing. So,
Yep.
So yeah, you want to make sure that you're investing. And the same thing can be true with companies, right? You don't want to invest in companies that have management that don't know what they're doing. That's
Right.
equally as dangerous.
Right.
Okay, the last one, Rod, number 4, was just a little bit of a different concept. I know the concept specifically as it relates to like stock investing, but I was trying to bring it like more holistic, making it more holistically applicable.
Mhm.
And the more I thought about it, the more I thought that it fit. So the 4th M is margin of safety. Okay, so margin of safety is basically so I'm going to read the quote and then I'll describe what I gather as to what margin of safety is and how it applies to what we're talking about. So margin, if the management meets those qualifications, right? The 3 that we talked about, the 3 M's above that, then step 4 is to calculate its margin of safety. Buffett, who's a staunch believer in the margin of safety, has declared it one of his cornerstones of investing. So I read that and I'm like, okay, well, let's dig into this a little bit more. And then he says it's been known to apply as much as 50% discount to intrinsic value of a stock as his price target. So he's just basically saying he puts a lot of stock into this idea of margin of safety. Well, margin of safety is still an interesting one, and you can calculate it in a variety of different ways. So I'm not going to get into the various calculations, but from a meaning standpoint, it just means the price point at which you believe that you can safely get a return. Now, that still feels very arbitrary, right?
Mm-hmm.
But that's really what they're suggesting is if you feel like, and again, it is based on research and due diligence and those other things, but at some level, it has to be based on what you think, right? You take in the data, and ultimately you're saying that I believe that in this situation, because of this margin of safety or all of these reasons, it's very, very unlikely that I'm going to do anything less than get my money back or have no return. And I genuinely believe that I'll do more than that. And that's kind of but again, you can look at the various different ways to actually calculate margin of safety and see if one of them applies more specifically to you. But I thought that was applicable as a whole, because at the end of the day, that's really like what we're doing. We're having to make a call when, as investors, we take in all of this information, right? We do the other 3 M's, and then we take the information and we have to make a decision whether we use specifically this concept of margin of safety or some other process to get there. The bottom line is we have to take the information in and get there in some way. And I thought that was a good way to kind of think about it in a good framework.
Yeah, it almost sounds like you're taking those principles and then building a process around it to create those buying prices, so to speak, or buying principles so that you can recognize a deal when you see one. Is that fair?
Yeah, that is a great point, right? I probably made it sound like it's just like, throwing, what do you throw up in the wind? A feather up in the wind and seeing which way it goes. It's definitely not that, right? Oftentimes it can have very distinctive metrics that it's taking in before it kind of spits out that result. Okay, Rod, quick review of the 4 M's, and then we'll call this a day. M number 1, meaning, find meaning. Number 2 is moat. Number 3, management. Number 4, margin of safety. And Rod, the conclusion that I got out of this whole exercise, and I've always believed this, but I hope that after we've talked about it together, that other people, if they've been on the fence on this idea, I hope that the conclusion you'll come to is that it's critical in investing in wealth building to focus on value, not just price.
Agreed.
Okay, thanks everybody for hanging out with us this week. And we hopefully will see you next week.
Thank you for listening to the Money Insights Podcast. To learn more about the financial and business strategies discussed in this show, please visit moneyinsights.net. The views and opinions expressed on the Money Insights Podcast are not intended to be individual financial, tax, or legal advice. Always consult with the appropriate advisor before making financial decisions. And if you're enjoying the show, please feel free to rate, subscribe, and leave a review wherever you listen to your podcasts. This will help others find the show and learn wealth building strategies for themselves. Thanks again for tuning in, and we'll catch you in the next episode.